have said that without proper and full reform, there not may be another financial crisis looming. There will be a crisis worse than the last. We've had a series of reforms, and the UK has gone further than almost any country in the world, I think any country in the world, in reforming its financial system. What hasn't been done? What is it that needs to happen to safeguard us?
I think the most important thing is to go further in terms of saying to banks, look, forget all these complex calculations to determine how much equity financing you should issue in your bank, because that becomes so complicated. It's based on studies of the past. Whatever crisis we face in the future, the past will not be a good guide to it. So I think we just have something very simple and just say that the ratio of the amount of equity finance that banks issue to the total assets of the bank should be enough to absorb a reasonable prospect of loss. There's no simple answer to what that number is, but I think it's higher than where we are. And the other idea that I have is to say we want banks to be able to finance long-term risky lending by issuing short-term deposits as well as issuing equity finance. And this has big benefits for the economy. However, it also creates the potential for instability with runs on banks as people decide, I don't know, what that bank is like, I don't understand the assets in the bank, I'll take my money out while the going's good. And the question is how you can stop that. So my idea is to say, what happened in the crisis in 2008? Well, what we discovered was when banks came to us and wanted to borrow from the central bank, this was true of all central banks, that they didn't have very much safe collateral to bring. So, when Royal Bank of Scotland came and said to me, well, we can't get to the end of the day, I wrote a cheque for £36 billion. Well, this is quite a good way of impressing professional sports players who think big in terms of money, and that they've never written a cheque as big as this. So it's a way of impressing them.
Nobody's ever written a cheque as big as that.
It's not often you write a cheque as big as that. So I said to my staff, I said, so what's the security we've taken on this loan? And they said, it's we call it raw mortgages. I said, what's a raw mortgage? Well, it's a mortgage of someone where you've no idea who they are or where they live, basically. and I said, well, this is a bit much, really, but there wasn't any choice. So I think what we have to accept is that in the modern era, central banks, when lending to banks who need temporary liquidity support, will always be lending against the security of risky assets. And if you're going to do that, it doesn't make sense to leave it until the day they need the money before you look at the collateral. When the lender of last resort role was invented in the 19th century, at that stage, banks had about 30% of their assets in the form of safe government securities, which, when you did need money at 3 o'clock on a Tuesday, you'd pop round to the Bank of England, put these assets on the table, and the bank would say, oh, yes, we'll lend you the full face value at this interest rate, and you've got the money straight away. But you can't do that when you're suddenly confronted with these risky assets. You've got no idea whose mortgages they are or what the assets comprise. So the way to get around that is to basically think of the central bank not as a lender of last resort, but as a pawnbroker. Because the 30% of the balance sheet, which was in safe government assets in Bagehot's time, Walter Bagehot, editor of The Economist, who created this idea, by 2007, that 30% had fallen in the United States to below 1%. So there weren't any assets against which central banks could lend easily. So what the central bank has to do is to recognize that banks are going to be bringing gold watches to the pawnbroker. And in 2008, some of those gold watches were broken or tarnished. So what needs to happen is that banks should do this well in advance, in normal times. Central bank has a team of people that will evaluate the collateral, take a month or so to do it, and then the central bank will say, okay, here's the deal. Against this collateral, which you are going to position with us now, in a crisis over the next 5 or 8 years, if it happens, we'll lend you 95 cents in the dollar or 45 cents in the dollar, depending on the nature of the assets. And that's a promise for the next 5 to 8 years. And you, oh bank, have to position enough collateral with us so that after the haircut that we'll take, that is the amount of the face value of the assets that we're not going to lend against, After we've taken account of that, you've got to have this credit line with us where you just bring the assets to us and we'll immediately give you the cash. You've got to have enough credit line with us to cover all your deposits where people could take the money out in the next month or so, the runnable deposits. And if you meet that criterion, there'll never be a bank run again, and we will have made the banking system stable.